In this strange economy, good news today means bad news for tomorrow, and we just got our latest jobs report in November, and it had some better than expected news. You'll see why this good news could be bad news for our future economy. The jobs reports that we get lag a little bit. Like the jobs report that we got in November gives us the September numbers, and what it showed us is that in September job openings increased, and that we have about 1.9 job openings per unemployed people. On an economic level, that's good news for today because that means, according to this data, it might not be what you actually feel, but according to the data, it means that for every unemployed person out there, there's almost 2 jobs for each person to choose from because there's more job openings than people. But let me read you a quote from a chief economist as to why this could be bad news for our future economy. The good news of more job openings for everyone will be bad news for everyone if the Fed officials become convinced that they need to push interest rates even higher and faster than before. Earlier in November, the Federal Reserve Bank did another aggressive rate hike, and now everybody's looking forward to what is the Federal Reserve Bank going to do next in December, and more importantly, what are they going to do in 2023? Because it's pretty obvious now, even if you're not an economics or finance person, that the more you raise interest rates, the more it affects the economy. Higher interest rates slow down the housing market. We are now seeing mortgage rates at above 7%, which means that now you're paying more than double for a mortgage which you were paying a year ago or even earlier in 2022. So the housing market is slowing down. We're seeing home prices start to fall across the country. We're seeing a slowdown in the car market because it's less affordable for somebody to buy a car because the interest rates on cars are so much higher. Businesses are slowing down. We've been seeing layoffs across the board because businesses have to pay more money to borrow money, and you have to pay a higher interest rate on the debt that you already have, because most debts are not like your 30-year fixed rate mortgage. Most debts readjust every few years, and so the businesses that have billions of dollars worth of debt that's readjusting at a much higher interest rate, well, it's a higher cost for the business, which means they have less money to go out and hire other people with. Now, if you listen carefully to what the Federal Reserve Bank says, you'll understand that they have 2 different mandates. Number 1 is maintaining maximum employment, and number 2 is managing inflation, aka price stability. And right now what the Federal Reserve Bank is saying is that inflation is still a big problem, and it's a bigger problem than the unemployment and employment problem because according to the Fed, the vast majority of people who want a job can get a job, so there's no issues in the employment market, which means this is not a concern right now, and this is the primary factor that the Federal Reserve Bank needs to work on. How do you work to bring inflation down? Well, you raise interest rates. Raising interest rates does affect this. It also impacts this. But the worry that people have is if you keep raising interest rates, businesses are going to have to lay off even more, and it's going to tip the United States into a deeper recession. And so this is where people are worried. How is this going to impact the unemployment and employment numbers if we keep raising interest rates? This is why the worry is that a good jobs report today could mean a bad jobs report in the future, because if we're constantly working to fight inflation, the Fed is going to keep raising interest rates, which will then ultimately hurt the employment numbers. Now, the question is what the Fed is going to actually do, because everybody's trying to predict what the Federal Reserve Bank is going to do, but we're not going to know until they actually do it. However, what they're saying today is that, again, they're not worried about this because the unemployment numbers and the employment numbers look good according to the data. However, they are worried about this because according to the data, this is a much bigger problem than this. So the Fed is willing to tip the United States into a recession to fight this, even if that means sacrificing some of this. Now, we will be keeping you posted on what's happening on this channel, but you can also join Market Briefs. It's a completely free resource that I created where every day my team is breaking down what's happening in the financial markets into a fun, easy to read and witty email. It's super brief. You can read it in less than 5 minutes every morning, and it's going to make you a better investor because it will help you stay up to date on what's happening in the markets, and it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. Now, the reason why I'm bringing up these 2 mandates, although it might seem obvious, is because not all central banks work like this. Like the central bank in the UK doesn't have this dual mandate system. They only have 1 mandate. And the 1 mandate is inflation. So over there, they can ignore this and just focus on this and do whatever it takes to bring inflation down. But this is where you have to understand what they're supposed to do isn't always what they actually do. Because even in the UK, where the central bank is supposed to be a separate entity than the government, they have a lot of pressure from the government. If the economy were to slow down even more in the UK, you start to see more layoffs, you bet that you're going to see all this pressure going on the central bank to then change course on this to then improve the employment numbers, even though that's not one of their mandates. That's why you got to also understand here in the United States that while the Federal Reserve Bank is supposed to be a non-government entity, it is not a part of the government. They even say so on their website, even though it is called the Federal Reserve Bank. It's not a part of the government. It is a completely separate entity, but it can be influenced by the government. And this is where you have a lot of people trying to trade based off of what they think the Federal Reserve Bank is going to do, because you have a lot of people who say that in 2023 the Fed's going to start cutting rates, that it's impossible for the Fed to keep rates as high. Why? Because the economy is struggling, the housing market's struggling, businesses are struggling. So there's no way that the Fed is going to keep interest rates high through 2023. But instead of trying to predict and trade based off of that, which is gambling, how about understanding the different options? That way you can make smarter decisions with your money, because the reality is it doesn't matter what the Fed does. There's going to be opportunities whether the Fed raises interest rates, keeps rates the same, or starts cutting rates. If the Fed starts cutting rates, well, that's going to create another boom in markets, because then people are going to take all this extra cash that they still have and take this money and put it into markets, because they're going to see rates being cut. And you're going to see more dollars start flowing into markets. People will start buying homes more aggressively. People will start buying more stuff more aggressively because it's cheaper to do so. If the Fed were to keep rates the same, well, then you're going to see asset prices continue to get hurt. I mean, mortgage rates are already at 7%. It's going to take a number of months before a 7% mortgage really gets absorbed into the housing market, and it's going to have an impact in the housing market. Just like that, if the Fed keeps raising interest rates, even if they raise interest rates slowly, they're still raising interest rates. And that's going to also create more impact on the economy, because while we're trying to get absorbed into the 7% mortgage rate and where interest rates are today, well, interest rates keep rising. And this is where people are saying, well, even if the Fed starts raising interest rates less aggressively, that's a win. But raising interest rates less aggressively is still higher interest rates, and that still makes doing business more expensive. It still means buying a home is more expensive. It still means that getting a car is more expensive if you're financing it. I don't recommend you finance a car, but if you're financing it, and that's where there's a difference between interest rates going down and raising interest rates less aggressively. It's kind of like when inflation went from 9% to 8%, and everybody said that this was a big win. But inflation is still growing. When inflation grows from 9% to 8%, that doesn't mean that inflation has started to fall. That just means that inflation is falling less aggressively. You went from having 105 fever to 104 fever. It's still a fever, and it's still bad. And 8% inflation is still high. And this is where you got to understand that there's going to be impacts and consequences to the higher interest rates. There's going to be impacts and consequences to the fight on inflation. And these things are going to take time. Now, I have a video coming out soon where I'm going to diagram the things that you want to pay attention to, which will show you when a recession will happen. But the key thing is going to be how much money people have, because right now, people still have a lot of money. And it might not feel that way because everything is so expensive. Rent is still so high, home prices are high, grocery prices are high, everything is so expensive. But if you look at the data, people are still able to spend. And when people can't spend the way that they can today, that's what's going to trigger a much deeper economic slowdown. And these are the factors that the Fed is paying attention to. So instead of trying to trade what the Fed does, understand the opportunities. That way you can find the best opportunity for you, so you can take better care of yourself, your family, and your community. Because the reality is things are not over out of this economic slowdown. Things are going to progressively get worse in 2023. And this is where you want to be financially educated. That way you can take care of yourself, take care of your family, and take care of your community, because you don't want to be relying on everybody else, because the lack of financial education is going to create a bigger divide between the people who have money and the people who don't. And this is where I want you to be one of the people who understand this. That way you can be one of the people that can capitalize on the opportunities that come our way. Go to school, get educated, but understand that wealth is built through equity. So earn a salary doing whatever you want, whether you're a doctor or you're working at a factory, doesn't matter. Take some of your salary, go out and build some equity. We're always taught and think and told that the way you do that is to follow the American dream of just buying a home, because now you can pay down your home